Earlier this month, the Silicon Valley Bank collapsed, along with two other financial institutions. In the wake of these fallouts, many are worried about their savings and investments. Here to discuss these bank failures is local financial expert Mark Triplett with Triplett-Westendorf Financial Group. Always great to have you. Unfortunately, this is kind of a downer, a worrisome topic, right? What exactly is happening with the Silicon Valley Bank?
Sure. So the collapse of Silicon Valley Bank was the second largest bank failure in U.S. history. Now, SVB really had a unique clientele. 90% of their business was startups and venture capitalists. And those firms are really burning through cash as we've seen interest rates rise over the last year. Now, since 2019, the average bank has increased deposits by about 34%. SVB actually tripled their deposits during that period of time, which you'd think was great because business was booming, but their loan activity didn't keep up. So they didn't know what to do with that money other than invest it elsewhere. So they chose to invest it, primarily the bulk of it, in long-term U.S. Treasuries, which are generally pretty safe. However, they got a lesson in interest rate risk. As interest rates rise, bond prices go down. And their bonds that they held, that were generally pretty safe, lost 40 to 50% of their value. When these venture capitalist firms and startups needed cash, they came to withdraw their money. It's not there. They have to liquidate these investments at a loss, and that was just too overwhelming for the bank to handle. So the Federal Reserve rolled out this bank term funding program aimed at safeguarding institutions from the fallout of SVB and really try to kind of calm the nerves across the industry.
Yeah, there is certainly a lot of nerves. I mean, people are just worried, is all my money vaporized, right? What happens when a bank fails? How can we help Iowans navigate this?
Sure. So banks fail when they cannot meet the obligations because of a lack of capital, basically money. And typically bank failures are kind of a self-fulfilling prophecy. As depositors kind of freak out that their money's not going to be there, they rush to pull it out, and that causes just a detrimental demand. So one of the things you can do is make sure that you stay under the limit of the FDIC Insurance Deposit Corporation's limit of $250,000 per person per bank. And if you are working with a credit union, there's actually an institution like the FDIC for credit unions called the National Credit Union Association. So being diversified amongst multiple institutions can help.
And what happens to your money when the bank closes down? Doors are locked, you can't get in.
Sure. So those that have deposits that are under $250,000, they will get their deposits back. If you have uninsured deposits that are above that limit, you still might get that money back if another financial institution comes in and purchases the failing bank. If that doesn't happen, those assets are sold off. The failing bank assets are sold off, and then you might be able to file a claim against that. But again, those are your uninsured deposits that are really at risk there.
Mark, how can folks find you? I think you always end with a piece of advice, is just remain calm at the end of it all, right? Where can folks find you for more questions for you?
Sure. They can find us online at Triplett-Westendorf.com. That's a great place to start. And as you said, remain calm. Most folks are not going to be impacted by this because their deposits are less than $250,000 and their banks are well capitalized. These kind of outliers, unfortunately, cause a lot of panic in the marketplace.
Absolutely. Thank you so much for your time. We really appreciate it.